last week. Sally Mitchell is with us. Sally's the mortgage broker at Mortgage Mum and joins us now. Sally, morning. Thanks for being with us.
Morning.
Have we seen moves since that decision, or was it, as the phraseology goes, priced in?
It was priced in with fixed rate mortgages. That's perfectly true. Excuse me. But anybody who is on a tracker rate mortgage or follows the standard variable rate of their lender will see pretty immediately a reduction in their monthly payment. That could mean almost £30 if you're on a tracker, average tracker, or about £18 a month reduction if you're following the SVR, standard variable rate. So there are benefits for people who are not on a fixed rate.
What about those fixed rates, Sally? What are we seeing? Are we seeing the big banks, the big building societies moving those, edging those down at all yet? Because they looked pretty flat when I had a look.
Yeah, I had a look this morning and the average 2-year is coming out at 4.95% and a 5-year at 4.7%. That is slightly up even on a week ago. And that's because although fixed rates are obviously set for a certain amount of time, if you're looking at getting one now, the people who are lending you the money have had to factor in an predicted rise in inflation. We're thinking on the 20th it might go up to 2.2% from 1.7%. The budget announcement of all the extra borrowing has affected the prices as well. Also the situation in America, although I suppose I shouldn't call it a situation now, it is an actual fact. And slight worry about oil prices. If oil prices rise because of all the unrest, shall we say, in the Middle East, then that could have a massive effect on the market as well.
And presumably, Sweta, that all means it's question marks about the number of interest rate cuts we have from the Bank of England going forward and when those might take place.
Exactly. I mean, we did hope there'd be another one before the new year, but that looks extremely unlikely. It was a very strong vote to have this cut of 0.25%, 8-1. And the word that Andrew Bailey kept using when he announced was gradual. So we're not going to see a tumbling. And I think they are the markets are saying it's not going to be 3%, 3.5 next year. It's more likely to settle at about 3.75.
Sweta
just coming on. Better.
Sweta just coming on that too?
Yes, exactly. So I would agree with exactly that, which is that it's data dependent. So the Bank of England the MPC will always be reacting retrospectively to actual increases in inflation that have taken place or that they anticipate. So at this point in time, we're expecting them to continue decreasing rates, but that the terminal rate is likely now to be slightly higher than previously anticipated. And in terms of mortgages, I mean, there's still a rising proportion of people who are coming off of their very low fixed rates that they had fixed during the pandemic next year into something that will be much higher relative to what was being paid in the past. So the overall stock of outstanding mortgages in the UK is still likely to see upward pressure on rates overall as time goes on.
Sally, what's the kind of advice then for mortgage seekers right now? Is it this might be the best it's going to be for a while, or is it still to sort of wait and see a bit?
It really depends on your individual situation. I would say to anyone coming off a fixed rate, start talking to an advisor, a broker 6 months before the end. Then that gives you a chance to snaffle a good rate in the hope that things will get better, improve, and we can get another one later down the line. But if things do go the other way, then at least you've got something in your back pocket that you can afford. I think that's the key. We need to get the consumers away slightly from the actual percentage points and just work out what's affordable. Because if it's affordable, over a 25-year mortgage, you are going to have times when your mortgage costs you more. You're going to have times when the mortgage rates are better. The key is it's got to be affordable for the whole period.
Sally, thanks so much for your time this morning. Sally
Pleasure.
Mitchell there from Mortgage